Welcome to part 3 of our lesson on money banks and monetary policy. We begin this lesson with what I like to think of as the middle school explanation of how banking began, or how the banking system began. Now, many hundreds of years ago, when money was only made of metals, you can imagine it's pretty inconvenient to carry. I mean, think about if you wanted to carry around $50 all in coins. Even if you have all dollar coins, it's still not really the most convenient way to carry money around. So you can imagine what it was like if you had large sums of money. Well, goldsmiths tried to solve this problem by holding gold for people. Plus, they also provided a safer place to hold than perhaps somebody's house. So goldsmiths began to hold gold, and they provide a receipt to the individual indicating that a person was the owner of gold, that a person held gold. So you had a receipt that said, you've stored, I'm going to use dollars just for simplicity, you've got $50 worth of gold at, Bob's goldsmith shop. So, that receipt would be, be enough for you to get your gold back when you wanted it. Now, what the goldsmith noticed, of course, well, maybe not. What the goldsmith noticed was that the amount of gold they held in reserves, right, that they held in their shop, was far more than what they needed for day-to-day operations. Now, you could imagine that the goldsmith, let's say you have a goldsmith that has 1,000 customers, and they each have $100 worth of gold, just for simplicity. We'll think 1,000 customers, each has $100 worth of gold. That's $100,000 worth of gold that the goldsmith has in the shop. But on a busy day, at most they might see 50 customers. So if they have $100,000 worth of gold, at most, maybe $5,000 worth of gold is added or subtracted in any given day. Well, if that's the case, then $95,000 worth of gold is just never even touched. Well, the goldsmiths figured out that they could use the reserves on hand to make more money. So they would lend out some of those reserves, right? They were banking. They started to lend it out and say, yeah, I'll let you borrow $10 worth of gold, and in 3 months you pay me back $11 worth of gold. People would agree to do that to take out a loan and be able to get this money back, earn that interest income. And by doing that, they could actually charge lower service charges to store money. So more customers might come and deposit their money because it's cheap, much cheaper to store the money at the bank or at the goldsmith. So the goldsmith would take money in from customers and sometimes charge a small fee for that, but then also be able to lend out a lot of the money they had stored in the back. So they didn't store everything in the back anymore. If they had $100,000 worth of gold deposited, and the goldsmith realized on any given day, at most, I'm going to really need to have $5,000 to $10,000 worth of gold, they could lend 90% of the gold out, or maybe even only 80% if they wanted to be really safe, and earn interest on that 80%. Right? If that's $80,000, if they earn 1%, it's $800 that they make by lending money out. If they can earn more than 1%, they get, well, you can do the math, right? Pick your percentage, figure out how much money they can make. Well, this is an example of what we would call fractional reserve banking. Now, that's where bankers don't keep all of the money in their physical bank location. What they do instead is lend out a lot of the money that they bring in deposits to people who wish to borrow money. So the goldsmiths, the system of not keeping all of the money themselves but lending some of it out, it's really not that different than what the banking system is like today, where the banks today, they don't hold all of the money in deposits, they lend a lot of it out. So and this is called fractional reserve banking. Now, the big thing on this is goldsmiths started making money, right? They got deposits, and they didn't have to pay any interest income on the deposits. Sometimes they'd even be able to charge fees, but they'd be able to lend out the gold and make money on the gold. The goldsmiths made a profit. And you'd think of banks doing this, right? Banks don't offer much interest, a very high interest rate on savings accounts or checking accounts. But they can charge 3.5%, 4% interest, 4.5% interest, I guess it depends on the loan type, for a mortgage, well, that can turn into pretty big profits, right? If the bank can get $1 million brought into them to store for free and lend that $1 million out for a 4% interest rate, that's 40 grand a year just on the interest. So goldsmiths made profits. This is how banks really make profits. Now, what goldsmiths then started to realize is people were treating the notes from the goldsmith like money. Right? Yeah, they didn't want to carry around gold. And you could imagine this is the case. If there's a reputable goldsmith in town that holds money, if you provide a service for somebody and they're going to pay you for your work, they could pay you in actual gold, but gold's inconvenient. Instead, what they could do is give you a receipt to say the owner of this receipt is entitled to $1 worth of gold from the goldsmith. Might be a lot more convenient to take that. Well, what the goldsmith realized is they could actually create money by writing a note indicating someone owned gold at the bank. So if they wanted to lend somebody money, they didn't even have to give the money from their vaults out to people. They instead wrote, why don't I just write you out a note saying you own $10 worth of gold at the bank, and you will pay me $10 worth of gold plus the $1 interest at the end of whatever the time period is. So goldsmiths actually created money by issuing out notes that people owned money at the bank. Now there is a downside to this. This behavior of lending out money, that more money than what's kept in the vault, does create an exposure to what are called bank runs. So if only a fractional amount of money is kept on hand, there's a risk that every customer could show up at once to withdraw money. That I'm sure you've heard of bank runs in the past, where people do show up at a bank at one time and try to withdraw money. And the risk of it occurs when you have a fractional reserve banking system. So the traits that we talked about in the Goldsmiths, which I think of as the middle school lesson on how the banking system began, I really like this lesson because it follows a lot of how current banks indeed also behave.